I'd like to call to order the meeting of the Oklahoma City Employee Retirement System for Thursday, December 13th. The first order of business, we need to elect a chairman pro tem for the meeting since our chairman and vice chairman are absent. Do I hear a motion?
Second.
All those in favor signify by saying aye.
Aye.
Anyone opposed? Motion passes.
Thank you. The first order of business is the approval of minutes of the meeting of November 8, 2018. Motions and minutes and a second. All in favor, please signify by saying aye. All opposed? Ratify approvals. First is payroll for the month of November 2018. The amount, motion's been made. And second, all in favor, please signify by saying aye. All opposed? Second is the payment of claims in the amount of $1,918.63 to the City of Oklahoma City. Motion has been made and second. All in favor, please signify by saying aye. Item 4 is approval of claims docket. Motions have been made. Do we have a second? All in favor, please signify by saying aye. All opposed? Item 5, approval of the following applications for service retirement. I believe we have 8 cases. Motion's been made. Do we have a second? All in favor, please signify by saying aye. All opposed? Item 6, receive report of death. We have 4 items here. Motion's been made. Do we have a second? All in favor, please signify by saying aye. All opposed? Item 7, approval of the following application of vested rights. We have 1, 2, 3, 4, 5, 6, 7 items, 7 cases. Motion's been made. Do we have a second? All in favor, please signify by saying aye. All right. Motion A, or item 8, individual considerations, resolution recommending by the City Council to adopt an ordinance relating to the personnel and retirement systems. Wiley, would you like to share with us a little bit about this, please?
Good morning. Seems like a year ago, but it hasn't been. But a few months ago, the ERS's tax advisor, Cindy Burley, advised us of some recent IRS rulings, private letter rulings, where they began interpreting a provision in the IRS code that requires a complete cessation of employment in order to initiate your retirement benefits. And in some of those IRS letters, the issue has come up for employees who resign or retire, and then they're hired back by their employer within a little bit of time, a short period of time. And they're saying that's not a complete cessation of employment. And they have not defined what that time period is, but in some of the letters that have been published or presented, they've determined that at least a 5-month period was sufficient. So in working with Cindy and advising all of her other clients, there's been kind of a determination that 90 days is a good place to start and see if that is sufficient. But the key is you can't retire knowing that you're going to be rehired, even in 90 days or 5 months. If that was your intent, then you haven't, in the IRS's opinion, ceased your employment. So you have to retire, and then if circumstances change 2 months or 3 months down the road, and you need to go back to work because you can't live on what you have the retirement, they'll say that was a complete cessation of employment. You had a change in circumstances. You can go back to work.
Okay, so if someone retires and then gets rehired after 90 days, but before 5 months, is that kind of a little bit of a gray area?
It's an uncertain area, yes.
Yeah.
But she's pretty confident that that will work. Because the key is quitting the employment without the intent to come back.
And if they're rehired after 90 days, do they have to pay back?
They'd have to pay back, right.
Yeah, wait, let me, So if they're rehired after 90 days, they have to repay it back?
No.
Or before?
Not right, only if it's
Before 90 days.
Before
Okay.
90 days. So after the 90-day period, there is no repayment
Unless,
penalty, so to
unless
speak?
we have evidence that they were going to be hired back.
Right. Okay.
Okay, I'm with you.
And that is to protect the
Need a motion.
plan. So we proposed the resolution so we can tell the council that the board considered it and recommends the amendments.
On page 17, when it's talking about the rehire before the 90 days, it says to be rehired in any capacity. Well, before it used to be full-time, but it says any capacity. Are
Right,
we
in
talking
any
part-time
capacity.
also?
Right. Yes.
Mr. Chairman, I just want to inform the board that this ordinance is on the council agenda for next Tuesday, December 18th, to be adopted with emergency, so it would be effective immediately to comply
Right.
with the end of the year.
Cindy recommended we do it by the end of the year. If we don't do it by the end of the year and we go into next year, then we have to make other revisions to the plan. So we're trying to get it in for this year.
And we need to approve it here
Yes.
to move forward.
Well, the council could do it without your recommendation, but I'd rather have your recommendation to say the board's considered it and they agree that it should be adopted.
Other discussion?
Hey, Wiley, remember what I was going to ask? Okay, on repaying the money now when they get fired or leave early, how much of, is it 30 days now we wait to give them the money back, or do you know what the time period is right now?
Currently what we're doing,
Yeah.
I don't think we're doing anything right now.
Okay, when they leave now, they get their money back. It's a pretty short amount of time.
Right, we are going to hold the money for the 90 days.
I mean, with this, yeah.
Right.
What are we doing right now? 'Cause they
Right
get the
now, we're
money-
not holding the money for 90 days.
Yeah, they just get it right away.
Right. Or as soon as you can go through the system.
Okay, I guess I'm a little bit confused. What are we holding for 90 days after this is adopted?
Their retirement benefit,
So if they retire, they're not eligible for a pension benefit for 90 days?
that's correct.
That, yeah, I'm a little bit concerned about that. I thought what this does was if they were rehired by the city in any capacity within that 90-day period, they had to pay the money back with interest.
Right.
That's how I understood it, too.
Yeah, and I'm a little bit concerned about them not being eligible for a pension benefit for 90 days. That could really create some
They're
financial
eligible for
hardship.
it, they're just not going, she's not going to start paying it out for 90 days. The reason they want to do that, as I understand, is because people take the money, they spend it, and they don't have it to pay it back in.
I'm really concerned about withholding a pension benefit for 90 days. I think that could create some financial hardships for individuals who are retiring when they have no other source of income and they're relying on that. The provision that I read in here says that if they are rehired by the city within that 90-day period, then they have to repay it back with interest. And I understand there might be some concerns on the system's part about collecting the funds, but I think that we would be doing our members a disservice by telling them you can't receive a pension benefit for 90 days following your retirement. I think that would create some financial hardships, or could potentially create some financial hardships.
And if we're not paying them, why does it have the language that they have to pay it back if we're not paying them in the first place? That makes sense to me.
There is a provision in there that
Right.
requires repayment with interest, and Randy makes a good point. If we're not paying them a benefit until that 90 days expires, why would we even need the provision that they had to repay it with interest?
We'll have to ask Cindy. I'll try to get you an answer before.
Well, I'm not in favor of approving this amendment if it's going to result in members not receiving a pension benefit for a 90-day period. I don't want to create financial hardship for our members.
Can we put this on hold for a little bit and
We can,
let me talk to Renee?
yes.
Yes.
Says-
So can we move it to the end of the docket?
We can, do you call it table it till the end of the docket? Is that how you,
Yes. Yeah.
do we need a motion to table it or just?
No.
Okay.
And Wiley, while you're checking on things,
I-
also check if they come back after 90 days. I know if they come back before the 90 days and they're part-time, it messes it up. But if they come back after 90 days, is it still, okay?
There's no penalty.
Okay.
Yeah.
Because it was saying it was going to stop the benefits. If you come back after the 90 days, your benefits stop. You don't get your retirement and get to work.
That's the way it is now.
I think that's probably true with most pension systems, that if you
I
return
don't
to
know if
work.
they come back part-time.
Oh, if,
That's what I'm wondering about. A lot of them come back just part-time.
Part-time, I don't think that applies to.
the 90-day,
That's correct.
after the 90-day period.
If you come back full-time and you resume into the pension plan, we stop your pension.
Okay.
But as a part-time, no.
We'll table this and hopefully we'll get some answers on those.
Pardon?
We'll table this and hopefully we'll get some answers before the end of the meeting. So moving to the amendment, to the investment policy statement, objectives and guidelines. Jason, you want to visit about the changes on here?
Well, Renee's making copies of the version that you can read the changes on. So if you want to come back to that, you can too.
We want to table that also, but do you want to go over the performance?
Sure.
We can do that.
And then the K2 Mauna Kea.
We'll move back to the reallocation of funds.
So sorry about that. You have the November ASAP in front of you. Just came from another meeting with a client up the street. The law enforcement moved their meeting to today from next week and had similar conversations as we're looking at performance through November. This has been a very volatile year. I think you may recall we had a chart in our first quarter, our January material, our year-end review, that showed the number of days in 2017 where the market moved plus or minus 1%. It was an all-time low. Just hardly any volatility in the markets in 2017. It was a good year. You saw equities moving up, but it was very measured paces. 2018 is certainly the polar opposite of that. We've seen significant volatility in the markets this year, beginning in February, where we saw a 10% correction in the equity markets, followed by a few months where equities made back some of the losses, or all of the losses, to where we ended, particularly in the U.S., to where we ended September with U.S. large cap and small cap up about 10%. International equities and emerging markets lagged pretty considerably. Negative returns there, primarily due to headwinds from a strong dollar, but you had very strong double-digit returns in U.S. equities, followed by the month of October, where we saw those gains wiped out pretty much completely in the U.S. equity market. So as of yesterday, the S&P stands at about positive 1% on a year-to-date basis. So still positive for U.S. equity markets, but it's been a very volatile ride getting there. Small cap stocks are down about 4% year-to-date. Non-U.S. stocks are still negative, with international developed down about 8% and emerging markets down about 10%. Month of November, we did see a pretty good bounce back, followed by a pretty volatile December so far. As we've talked about this year, we really feel like we're in the late stages of this economic cycle. Valuation is pretty lofty coming into this year. As Dennis mentioned, if we could just avoid having any geopolitical issues, or more importantly, perhaps avoid any tweets by President or others that make the market move plus or minus 2 or 3% in a day. Really, fundamentally, as we look at what's going on, there's a couple of major drivers that are occurring right now. One, investors nervous about how aggressive the Fed will continue to be with rates.
Thank you.
They've been pretty measured in these quarter-point raises to the Fed funds rate over the last 2 years, but continuing to indicate wanting to get back to equilibrium. Historically, the Fed funds rate has been about 4%. That's the historical average. We're still a long way from that, about 2.75% away from that. It's not anticipated that we're going to get there, and particularly in the most recent comments by the Fed, it sounds like they're perhaps backing off of their position or will revisit based on data. That said, economic fundamentals still look good. Inflation is low, although we're starting to see a little bit of wage inflation, and unemployment numbers are continuing to be at all-time lows, and those have been the primary factors that the Fed is looking at, getting unemployment down and getting 2% inflation into the market. So haven't necessarily gotten to that point yet. The other major issue out there is certainly trade, tariffs, and the uncertainty surrounding that, causing a lot of uncertainty in the market and for a number of different sectors. So as we sit here today, your portfolio on a one-year basis is up about 0.5%. Giving up year-to-date, you're slightly negative, down 70 basis points, whereas your policy index is flat. It's a 0% return for the policy index. As I mentioned, we've seen quite a bit of bumpiness in active management. We would expect active managers to add some value in a challenging market environment over the course of that cycle. Really what we're seeing, particularly this month with a big bounce back in November, a lot of active managers had a lot of defense in their portfolios and didn't get that bounce back. The biggest dispersion in returns in your portfolio is coming from U.S. large cap on a one-year basis, particularly in tech. You're primarily passive in large cap. You have the SSGA strategy that represents about 50%, and Intech, which represents about 50% of your large cap. Intech is an enhanced index. It's an active strategy, although it's not based on fundamentals. It's a mathematical process that weights the stocks in the large cap index based on individual stock price volatility. What that tends to lead to over time is that they are overweighted to the smaller end of the large cap universe. So they're not investing in small cap, it's just the smaller companies in the large cap index. As the market turned, the larger mega cap companies held up better than the smaller cap companies. And so in this recent period, that's been a major headwind, causing about over 4% underperformance in the last 1 year. They're up 1.6% versus the benchmark up 5.92% in that 1 year period. So that's really that manager, and the large cap allocation is really what's causing the dispersion relative to your policy index. Over time, since inception going back 10 years, they're 10% or 10 basis points ahead of the index. So if we went back a quarter, that number looked a lot better. Historically, it's about 75% of the rolling 3-year periods. Intech is delivering that excess return without a lot of benchmark risk and at a benchmark price. So we have seen this kind of relative underperformance from Intech from time to time, and it's particularly at a lot of folks think, well, if the market's volatile, shouldn't that help Intech if it's a volatility capture strategy? It's not market volatility, it's individual stock price volatility. When the market moves all in one direction, down or up, that kind of volatility isn't necessarily, that's not what's beneficial there. So that's been a major detractor from performance, as well as being overweight to large cap. And I'm pointing this out because as we look at that 1 year number, about 50 basis points behind your policy index in a challenging market environment, just want to understand where that's coming from. Overall, small cap, long short equity, a little bit behind, not no concerns there. Private equity, you've had a good year in private equity. As private markets, you've seen distributions in the private markets and get a bit of a valuation lag there, so it's not hurt as much, but your overall private equity is up 15% when markets are flat, so that's been a very additive. International equity, combination of your Lazard, Harding Loevner, as well as your, just Lazard and Harding Loevner, they've done a good job protecting on a relative basis, still down about 5%, whereas the benchmark's down 7.5%. Much smaller allocation, so it's not having as big of an impact. Fixed income lags slightly, some of that due to Brandywine, the emerging market exposure in the Brandywine strategy on a one-year basis, is that's lagged a bit. You look at 3 and 5 years, well ahead of your policy index. And then the real asset or real estate component, you're getting good performance there, about 2% excess return to real asset composite. So overall, it's been a bumpy ride. We continue to be cautious as we look forward. Expected returns going forward are much more muted. Even though valuations have come in quite a bit, we have concerns about slowing growth, slowing earnings growth as well. While PEs have come down quite a bit in the market with this sell-off, you're starting to hear some caution from company management about earnings growth going forward. And so we're concerned as we move into the next year. Our expectations aren't necessarily for a recession, but mid-single-digit returns in equities is probably more likely than what we've seen over the last 8 or 9 years. So did we pass this policy out? Okay.
You want to talk with item 8B now on investment policy?
Sure. So hopefully Renee just handed out the policy with the highlight and the red line that you can all see. So a few changes. Randy had pointed out last month that your core real estate was above the target, so we were addressing that, but a couple of other changes. There's language throughout the document with respect to meeting managers. I think the language was on an annual basis. Just soften that to say on a periodic or as needed basis, which is what you've been doing. The real substantive change is on page 5, these target guidelines. So as we looked at this, I think what we had done when you added real estate and added private equity, you were starting from 0. So the ranges we had put on those asset classes were much narrower because we were at 0. So we didn't give as much room on the upside, but as you've gotten to your targets, it's appropriate to expand these out consistent with other asset classes. So starting with emerging market equity, you see it was 0. The target's 5, it's staying 5. It was 0 to 7.5, just expanded that to 10, plus or minus 5 like the other asset classes. Same with private equity, just expanding that range to plus or minus 5%, consistent with other asset classes. We're not going there, it's just giving it the same flexibility. And then on real estate, it was 0 to 8 for core, 0 to 6 for opportunistic, and 0 to 7.5 for commodity. So we just expanded all of them out that weren't already at plus or minus 5 to plus or minus 5%, just to give you a little bit more room there. It's not changing the target allocation at all. The asset allocation stays the same, but this was just expanding out those ranges. And really the reason why they were lower before, I think, is those were all new asset classes that were starting at 0, and they were smaller. So that's the biggest substantive change. The other, on page 6, just clearing up because you have moved your assumed rate of return down. That first objective just stating, as opposed to putting a number in that may continue to change, just stating it's the current actuarial rate of return assumption and then what it is today in parentheses. The other item within the manager guidelines and performance criteria added tenure, just that we look at managers on a 10-year basis too. We're doing that, but it wasn't stated. You'll see that on bottom of page 7, and that carries through to all the other asset classes. That change, as well as the change to periodic and/or as needed as opposed to annual meetings with managers.
Okay.
So
Questions?
our recommendation would be to, well, first, unless, is there any questions? So our recommendation would be to move to approve as proposed in the red line version.
Motion's been made. Is there a second? Second. All in favor, please signify by saying aye. All opposed? Item 8C, reallocation of funds among managers on the K2 platform.
So you all have this K2 book. So as you know, on the K2 Mauna Kea platform, while it is a custom fund of funds platform where you have the ability to allocate to managers on the platform and pick the percentage allocations, there is a little bit more involvement on the board's part, particularly if something changes with respect to one of the managers. So unfortunately, there was a change at one of the managers that occurred sooner than we would have hoped for, but it's something that we're able to address. Kingdon Capital, which is one of the core managers within the platform, notified us last Thursday that 3 members of the portfolio management team were being let go. This strategy is managed by Mark Kingdon. He's the principal, he's the founder and senior portfolio manager, but there were 3 other portfolio managers that he would allocate capital to that would all manage a portion of the portfolio. He decided to let those 3 go last week. We were notified on Thursday as well as K2 before the announcement. We think that's a change to the thesis regarding this manager. It's about a $1.2 billion fund. $600 million of the assets are Mark Kingdon's personal assets, so he's still got a lot of skin in the game, but we feel it's a major change to the thesis. There is a 1-year lockup on this fund from the time you got in. ACG, along with K2, was able to negotiate with Mark Kingdon an exception to that lockup to allow clients of ours that had just gotten in to be able to get out at the end of the year by providing notice by the end of the year.
End of year 2018 or 2019?
At the end of 2018.
Okay.
Otherwise, the lockup would have lasted for you all till next August when you initially got in. So the summary of this is simply recommending, it's laid out on the executive summary on page 3, we'd recommend putting in a full redemption from the K2 Mauna Kea LLC K2 Kingdon Association Series for January 31. That would be the redemption date. In order to do that, the redemption request would need to be submitted by the end of the year. And it's just a form for the K2 platform. You just submit a form for that. And then reallocate those proceeds across several of the existing managers on the platform or that are already in your portfolio, and then adding 1 manager on the platform that you're not currently in, which is Engaged Capital. That is outlined on page 7. So the proceeds would be, Kingdon was considered a core manager on the portfolio, in the portfolio, and opportunistic, meaning they could move their exposure to the markets up and down. The proposal is to reallocate that. They're about 10%. So reallocate 5% of that, 1% each, to existing core managers in the portfolio, which are outlined on page 7, and then 5% or half of that to engaged capital, which is a small to mid-cap value activist manager that's on the platform. In terms of what that does to the portfolio, I think the best way to look at that is on page 11. Just remembering what we're trying to accomplish here is that we're trying to get lower net exposure to the market overall as you roll all these managers up. On page 11, in the middle of the page, you see it says long-short portfolio. The first set of numbers is the exposure, long, short, gross, and net, and really focusing on that net exposure. That's the long minus the short exposure that gives you how much exposure you have to the direction of the market. Currently, with Kingdon and the allocation that you have, it's 62% net exposure. 99% long, 37% short. So you subtract the longs from the short from the long, and that's 62% net. The modifications we're making, proposed, removing Kingdon and adding these other managers and these percentages, we'd maintain that 62% net exposure, so still the same hedge. The little bit of difference as you move to the right, particularly in terms of market cap, you getting a little bit more small cap because engaged is primarily small to mid cap, which right now you're going to move from 36% to about 40% in the small to mid cap space, so getting a little bit smaller, but we're not uncomfortable with that. So the real action to be taken today is just move to submit the redemption from Kingdon by the end of the month, and then reallocate those proceeds in accordance with this recommendation. That wouldn't occur until March because the money from Kingdon would not come back until February. It would be an end of January redemption.
If we approve this today, is the chairman authorized to execute any necessary forms?
The chairman or the...
Normally, the treasurer does all redemption requests, and they are authorized signers.
Questions, comments, discussion? I'd entertain a motion on reallocation of funds among managers. Motion's been made. Do we have a second? Second. Motion's been made and second. All in favor, please signify by saying aye. All opposed?
Mr. Chairman Pro Tem, as Secretary, I want to make clear that the motion was to provide notice for the redemption to K2 by December 31st and to recommend allocating the proceeds received from the K2 to the managers outlined on page 7. Is that correct? Okay,
That's correct, is it? I thought you said that.
And that's what I voted on.
Okay, thank you.
So I'll just caveat that is what I think the motion should be. We may need to revisit that, the reallocation dollar amounts in February in the event that the market move, the market changes and the value of what's coming back is different. But the percentages wouldn't be different.
Understood. All right.
What was the motion clear regarding the percentages versus the dollar amounts?
I think that might be in accordance with the percentages proposed on page 7.
Yeah, it was, the motion is in the total amount of the $5.5 million. It wasn't broken down. Does that answer your question?
Well, I want to make sure that the motion was for the percentages. Jason says the
Yeah.
percentages won't change.
The
I wanna make
percentages
sure it
won't
was
change,
for
the dollar
percentage.
amount may change.
Yeah.
So I proposed the reallocation would be in accordance with the percentages on page 7. Then we wouldn't have to revisit it.
So
And I
we
just
need
want to make sure that the motion and what we voted on was clear based on just the percentages and not dollar amounts.
Regina, can you, can you provide a motion to rescind your previous motion?
I make a motion to rescind my previous motion.
Okay, motion's been made to rescind the previous motion. Do we have a second? All in favor, please signify by saying aye. All opposed? Now we,
Now, the floor's open for a new
new
motion.
motion.
Make a motion to reallocate,
To redeem from Kingdon,
redeem from K2
Kingdon,
Kingdon,
and then reallocate.
to reallocate in accordance with the percentages listed on page 7.
Second that motion.
Motion has been made and seconded. All in favor, please signify by saying aye. All opposed? We're having a lot of fun today.
Yeah.
All right. Wiley, would you like to get up and talk to us about 8A? Thank you, Jeff.
I would, and I will apologize for confusing the issue. The pension gets paid as it always does. What is changing, however, is if you retire and you request your employee retirement account, that is held for 90 days.
So if you request a refund of your contributions to the system, then that is not paid out until the 91st day after you leave service. So if you retire, you get an immediate pension as that you normally would under the normal process. There is not a 90-day waiting period for you to receive a pension benefit. The only other question I have, Wiley, is regarding page 17B, section 5B. The language says that if an individual is rehired after 90 days of termination of employment, well, I guess that won't matter. I was going to ask if that needed to be full-time or part-time.
It's in any capacity.
Okay, so if an individual is hired after 90 days, even in a part-time capacity, their pension benefit will cease.
That's correct.
Renee says no.
No, if it's part-time, no.
didn't say that.
Yeah.
It's-
Right.
If you're hired as an employee, which is the capital E, which is defined as a full-time employee of the city. Little e is part-time. So if you were hired as a part-time, it doesn't affect your pension.
Okay.
Unless you come back within that 90-day period. After the 90-day period, then if you come back as a part-time employee, it is not, your pension is not affected. If you come back as a full-time employee, a capital E, then your benefit is suspended.
Okay, so because the layperson is not going to understand a large capital E and a small
Not
e.
just a layperson, I'm telling you.
Well, you're right,
Yeah.
because none of us understood that. Do we need to clarify that to say a full-time, as a full-time employee of the city after 90
Renee will
days?
testify, I tried to do that with Cindy, and she kind of objected.
Try to do that as the way she's reading it as the way the IRS reads it and wants to define what you already have in your document that they've already approved. We have the word employee defined already in the document, so she's trying to have the same.
Trying to be consistent.
Correct.
Can it be in the memo that goes to council, though, somehow, or?
Well, it will definitely be in these minutes that Section 5B does not refer to part-time employment.
Right.
That is
So-
correct, and that's the way it currently is now. That part really didn't have too much of a change, except now it's, if you're rehired after the 90 days of termination, your benefit's still suspended, but we just highlighted that your benefit is now subject to the cost of living, it's going to move up, just kind of clarify those provisions. But we've always had that part of the provision, as if you came back as a full-time employee, then your benefit is suspended until you actually sever service again.
Okay, so I want the minutes to reflect that under Section 5B, this only applies to full-time employment. if you are reemployed by the city as a part-time employee, this is for anybody who might be listening or watching, if you are reemployed in a part-time capacity and you are receiving a pension benefit and you are reemployed after the 90-day period by the city of Oklahoma City, that will not impact your pension benefit.
And
With one caveat.
with no further evidence that
Right.
you intended to come back at the time you retired.
Yes, what Wiley just said.
I have one. And that was employee with a capital E
That
after
was employee
full-time?
with a capital E, full-time.
So are we planning to have some sort of education for all the rehiring managers throughout the city that they can't make promises to people?
Okay, well, let me just say this. I think that what needs to happen is that at the time an individual is seeking or contacting the retirement office, the Employee Retirement System office, to initiate retirement benefits, they need to be advised at that time or provided some kind of document that.
We are providing them that, but a lot of times they've already made some decisions ahead of time with the promises of all this being happened. So it would be nice if the city would also make sure departments understand.
Well, and
provisions.
we can certainly do that. Issue, once council adopts this item, we can issue information to department directors so that they know that they can't contemplate hiring somebody within that 90-day period.
And we can probably bring it up at the next department head meeting.
Absolutely.
Other questions, discussions?
Open.
I appreciate this dress rehearsal for next Tuesday.
You appreciate what?
The dress rehearsal for next week.
Okay, good luck.
Okay, so on, when they leave, and what worries me is if somebody gets into some terrible accident and has to resign and take their payout.
They will wait 90 days.
91 days, because somebody could literally lose their car and house and their everything in 90. When we mail it out now, do we do it immediately when they sign that paper?
No.
We would-
Well, would they sign the paper, but
When they
they
sign
will
the paper.
receive they don't receive the packet of information because of the way payroll works until the second payday after they've already left, because all contributions have not been remitted to the system. Any adjustments have not been made through the sick leave and vacation leave to know what their final account balance is. So that's about 30 days to begin with before they're actually sent the paperwork. And then when they send it in, very few are sending, if they wait another 30 days, then you have just another 30 days on top. I mean, it's just, and as the IRS states, retirement is meant for retirement purposes, not for other purposes.
It's
Give me
not
my
a
money so I
savings
can leave.
account.
Right.
Okay, so before we vote on this, going along with what Jackie said, is it possible that if we're going to issue information to the employee as they're leaving and department directors that you can't be reemployed, that they can't contemplate reemployment without adversely impacting the former system participant? Is the 90 days really necessary, or the 91 days still really necessary?
We believe so.
We've had several instances of employees, particularly with the golf pros, at the golf
Courses.
clubs, employees resigning and then being rehired and just repeating that cycle several
As
times.
soon as they receive their refund.
Okay,
And the purpose is not a savings account, it's a retirement account.
correct. Do we, just out of curiosity, do we have a lot of people, in addition to the golf course, do we have a lot of employees who are leaving the city and requesting a refund of their contribution? I mean, on average, do we have, what do you think?
90% of the employees request a refund of their contributions.
90% who leave?
Hardly any, right.
Those that are not vested.
Correct.
Other discussion? This is good. What would be the pleasure of the board? Do we have a motion? Motion's been made. Do we have a second? Motion is made and seconded. All in favor, please signify by saying aye. Aye. All opposed? All right. Motion carries. Item 10, elected chair for the term of January 1st, 2019 through December 31st, 2019. And as a note of information, Paul Bronson has said he would be happy, wasn't that the word he used? Wasn't that the word he used? Happy to serve another term. So, do I have nominations? Paul Bronson has been nominated. Do we have any other nominations? No. All right. All in favor of Paul Bronson being the chair for this term, please signify by saying aye. Aye. All opposed? Item 11, elect a vice chair for the period of January 1st, 2019 through December 31st, 2019. And I believe Ken, he did not say that he would serve another term, but I assume that he would. And if not, then I'm sure he would step down if he doesn't want to. But do I have nominations for vice chair?
Nominate Ken Colbert.
Okay, motion has been made and second. Any other nominations? Any other nominations? All in favor, please signify by saying aye. Aye. All opposed? Item 12, comments from the board, staff, and citizens.
Mr. Chair Pro Tem, I think you did a fantastic job.
Thank you very much.
I do want to offer one more comment about the ordinance. The changes are required in order to protect the tax-exempt status of the plan. If we don't make the changes, then we risk the tax-exempt status of the plan, and that will affect everybody.
But we aren't doing the safe harbor. We're doing the 91 days. All right. Any other comments? Entertain a motion to adjourn. Motion's been made and seconded. All in favor, please signify by saying aye. All opposed? We are adjourned.